Good evening, this is Ken of Tortoise Capital. Let's take a quick look at an ATR volatility study on daily charts offered by one of the guys in the chat room. So we're looking at ATR 10, or I'm sorry, ATR 14 of the S&P, looking back a couple years. And we've got we got daily candles and a 50 period moving average and volume, and on the bottom we have an ATR 14 in dark green, the ATR 30 in blue, and then as a medium ATR, and then an ATR 100 in red, sort of a slow rolling, almost a seasonal approach. And we've marked off just under 35 and 20 as the boundaries of normal. That's not inconsistent with our little ATR study from the daily report if you look at the S&P. As a reasonable place to draw a boundary of normal. And so one of the things that we can notice is that when you've had long periods of below average volatility, you might call that a quiet market when all three are below that lower control limit. And the first thing that breaks is the 14. When it goes from very quiet and now starts approaching back towards the lower bound of normal, no danger yet, but you should already be feeling like, yeah, this is an amazing run here. And we can use the slope stat to help us determine just how extreme that 30-day rise over run really is. And then the break up of volatility here, you just notice coincides with this tremendous sell-off all the way through this volatility piece. The decline in volatility represents an opportunity. In this case, it never got below that lower control limit. When it finally did, just notice that this coincides with a long period of opportunity, and so the reduction of volatility coming out of the market is always a good thing for long-term price gains. And then by this time, the 14 and the 30 had all gotten into quiet. The 100 had slowly gotten back to the low end of normal before the next spike occurred. And again, this spike happens right in this period. Now, that also coincides with the break of the 50. And so there's a separate thing that we can use off this study, and that is price behavior at the 50. Now, you would see the same thing near the 200, but the 50 gives us an even accelerated view of that. This is maybe the more aggressive, 4 times faster than the 200, and it's worth your attention for longer term patterns as well. So this spike from quiet all the way above. Now, if you wait till it's very volatile to begin to do your hedging, then you're probably wrong. So there's somewhere along in here that RLCO framework and the 4 seasons of the MACD histogram can give you insights into what are reasonable trailing stops to allow you to participate in the moves up based on the normal pullbacks, but then when things crack, you're in a position to deal with it. Notice that even after a long spike up, which gets you to here, and some recoveries, that there's still room for another whole new level of pain when ATR 14 got up as high as 65 at the peak of the selling at the end. That's just how bad October through December of 19 at the end of 18 was. If we were to put a 10-period moving average on that green line, you would recognize that somewhere around in here there's some opportunities to get going. And then this, one of the most amazing bull markets ever, a measured pullback of about 10%. So from 29.50 to 27.50 in 2 legs. Leg 1, pause, leg 2, and then another beautiful run. And then this most recent, about an 8% sell-off. So the different volatility indicators give you some ways to estimate the different volatility regimes based on the look-back period. When the long-term ATR 100 is above, then you know that there's something going on. But when it crosses, look, it takes this long for it to cross back into normal, by which time the faster volatility corrections would have given you a much better look. In fact, you could take a look at when the fast crosses the slow volatility as sort of a not later than, although that was still 200 points worth of move while you were waiting for that. To me, those percent stretches and RLFF and the owl patterns give us opportunities to get better entries. But in terms of stepping back and looking at the longer-term volatility regime for long-term asset allocation, there's a lot of goodness looking at things just through this lens. So we are at right now a 50-day moving average resistance with short-term volatility has just moved into volatile, and the 30 and the 100 are near the upper limits of normal. So this is not an unusual time for it to either race back to the top or to collapse or to muck around further. That price around the 50 acts like a real important meeting place of all the minds. So let's just go back and look what happened the last times that it was near the 50. Found some support, but mucked around for a week before it decided to move. This time it came up and then rejected for about a 5% sell-off. This time it hit, broke through, came back and mucked around before failing. Each of these you could look at as a resumption prior to coming back and testing. So that was maybe around the 20, I would bet. That's where you would see owl patterns inside here, or at least pocket re-entries or emerging dragons give you insights into new highs. At this crossing of the 50 or the touching of the 50, notice you got a higher than normal time spent or mucking around trying to decide what to do, and it's going to go up. Here I take this as a rejection of the 50, a rejection of the 50, another rejection of the 50, another rejection of the 50, a collapse of the 50, and when it broke, big time sell-off, harsh. And then failure, it only got 50% of the way back. So now you can start thinking this as a stretch down. All of these little pullbacks and then resumptions, all these little pockets, are places where failure to even go test the 50 is an important insight. Found support of the 50, broke through the 50 finally. So test, reject, and then finally goes. And then what was once resistance has now become support, then all the way back up. A collapse, and then that's what makes this run up just so remarkable. There was really no looking back ever. So that's what I want to say about the 50 moving average, the three different volatility regimes, and why a boundary of 20 and 35 is not irrational. It gives you some very interesting insights. And then you can look at where each of those lines are, and when they're all together, you can be sure that's an indication of has been quite a remarkable move. Now, this move was so volatile in your favor that it even brought it out of the quietude and then up back into the lower edge of normal. Even though volatility in this case was in your favor, it wasn't a volatility spike until it got this high and started to collapse. And anytime you get beyond this with the 10 and joined by the 30, you know that there is a different kind of a market underway and that different rules apply. So thanks for your kind attention. That's the ATR study. Thanks to the chat room for offering me an opportunity to comment on a really important topic. Take good care.